Most traders react to the past. Professional traders predict the future. Do you want to know how supply and demand gives you the edge before the market moves? Stick around. At the end of this series, you should know where the real money lies and be able to execute low risk, high return trades with ease. We're going to break down some of the biggest mistakes that retail traders make, and then we'll show you how to solve them. First, I'm sorry to disappoint you, but I'm going to tell you that the majority of what you've already learned in trading manuals is wrong. Give that some thought. If the vast majority of retail traders lose money, do you want to be following the same practice? The biggest mistake that retail traders make is that they wait for trend confirmation. While you're waiting for the bullish or bearish outside candle or your indicator to cross to initiate your trade, institutional money are already in the trend. Institutions, they use predictive analysis, not reactive. They already know the zone where the orders sit. Let's take this back a few notches. What does a price chart tell you? I'll give you a little time to think about this question because it's very important. Okay, that's long enough. A price chart tells you where orders have been executed. I'm just going to pause again there. The last word is by far the most important. Let's let that sink in. Executed. It tells you the levels where buyers and sellers agreed and orders have been filled. What a price chart does not tell you is where all the unfilled orders are. This is where supply and demand comes into play. Say I'm an institution and I've got unfilled orders. What do I need to do? It's simple. I need to get them filled. I need price to go back to where those orders are. It is the unfilled orders that make price move, not the completed trades. We can all see where the trades are being executed. What we cannot see is where the resting orders sit. This is lesson number 1. Lesson number 2 is trade like an institution, not like a retail trader.
Show me the money!
First question you should ask yourself before executing any trade is, am I trading like an institution or am I trading like a retail trader? You need to change your mindset. Don't look at the chart and purely analyze the history of filled orders. Look at the chart and ask yourself, is it likely that standing or resting orders have been left at the price I want to enter? So what's lesson number 3? Don't trade breakouts. By the time your structure breaks, price has already moved. You're entering late, your risk increases, your reward shrinks. What have we all been taught? That a change of trend or direction is a move from higher highs and higher lows to lower lows and lower highs, or a move from lower lows and lower highs to higher highs and higher lows. And in some cases this is true, but a trader that blindly trades a break of structure is missing the big picture. If we trade breakouts, although we may well have got our trend reversal confirmation, our reward to risk ratio would have diminished greatly. In this example, the breakout R rate is just 1.4. Trading at confirmed supply and demand levels greatly improves one of the biggest battles you face: productive money management. The reward risk ratio is more than double from that of the breakout strategy. Let's discuss what supply and demand is not. It is not trendline resistance or support. It is not chart formations. It is not a stop loss hunt. It is not the previous swing high or previous swing low. It is resting unfilled orders. That is not to say that we cannot use analytical tools to analyze the market. In fact, in the last episode in this 3-part series, we will highlight how to calculate arrow sharp entries using exactly these techniques. So, how do you pinpoint these supply and demand zones? We're going to show you in the next video in the series. This is a must watch. And if you want to watch our next video on supply and demand, subscribe to the channel.